have a busy week for central banks ahead of us, as the Reserve Bank of Australia will announce its latest interest rate decision on Tuesday the 9th, followed by the Bank of Canada and US Federal Reserve on the 10th, and the Swiss National Bank on the 11th. As we can see from this first graphic, their trend in headline borrowing costs in all four countries is down. And as I sit here, there have been 126 global interest rate cuts in 2025, against just 21 increases to date, as markets have started to price in more, especially from the US Federal Reserve. The CME FedWatch service puts in a 90% chance on a quarter-point reduction from the Fed down to 3.75%. Watch out also for any steer from Chair Jay Powell on the outlook for 2026, where markets are currently looking for 3 more cuts down to 3% by next Christmas. Also watch out for any discussion of the US Central Bank's plans for its balance sheet. At the October meeting, Mr. Powell and his colleagues halted quantitative tightening, or QT, and the shrinking of the balance sheet. That may be one thing that gold and silver bugs sniffed out a long time ago, and it may also be a factor in keeping US stock markets buoyant. The real test, however, may be whether the Fed returns to asset buying and quantitative easing, or QE, if unexpected economic or financial trouble come around the corner anytime soon. Those policy decisions are likely to be the most influential statements so far as markets are concerned in the coming week, especially as the scheduled state of corporate announcements is starting to thin out a little bit. However, names which may be worthy of research include the following, pending any late or unexpected change in the dates: Ashtead, Moonpig, Chembring, Begbie's Trainer and Oxford Metrics on the 9th, Red Centric and Procook on the 10th, and NCC and RWS on the 11th. But 2 statements that could really write a few headlines may just be those from British American Tobacco with its 4th quarter trading update on the 9th, and Berkeley Homes, which is releasing first half results on Wednesday the 10th. Shares in BAT are trading near 7-year highs, helped by June's upgrade to revenue growth guidance and an enhanced share buyback this year, as well as consistent dividend increases over time. Sales of shares in ITC, an Indian conglomerate quoted on the Mumbai exchange, have helped to further underpin the cash returns to shareholders. The FTSE 100 member is overcoming ongoing declines in cigarette volumes with higher prices, cost efficiencies, and growth in its next-generation product categories. An analyst will benchmark this full-year update against the upgraded guidance provided by Chief Executive Tadeu Marroco earlier this year, namely, constant currency revenue growth of between 1% and 2% for 2025, and adjusted operating profit growth of between 1.5% to 2.5%, excluding Canada, where prior litigation settlements have been adjusted downward. Now, on a headline basis, analysts are therefore looking for sales of £25.5 billion for the year, up 2% on a constant currency basis, an adjusted operating profit of £11.4 billion, also up 2% year on year. Add up that lot, and analysts expect a gentle dip still in the headline adjusted earnings per share figure for this year. Watch out for any discussion of new excise duties in Australia and Bangladesh and currency movements as well, and also whether BAT feels able to make any comment on the outlook for next year, though it may leave that till February's full year results. BAT may also leave alone any discussion of its medium-term growth goals till next year. The key target here is to generate £50 billion in free cash flow between 2024 and 2030, or something like half of its current stock market capitalisation, and that cash should really help to funding that returns to investors through dividends and buybacks if that target's met. Now, shares in high-end house builder Berkeley stand no higher than they did in 2017, dogged as they have been in the past few years by higher interest rates, weaker consumer confidence, input cost inflation, and the building safety levy, which is designed to help fund fire safety and other defects in high-rise buildings. It'll be interesting to see if Chief Executive Rob Perrins has got anything to say on the budget's supplementary council tax charges, whether he thinks it might influence demand for Berkeley-built dwellings, where the average selling price in the last financial year was £593,000. September's trading update contained no great surprises, so analysts will look to Mr. Perrins for further reaffirmation of the company's profit guidance, which is for pre-tax income of £450 million in each of the years to April 2026 and 2027. The benchmark for these first half results is the £275 million earned in the first 6 months of last year, although Berkeley has said it expects a pretty even split this year between the first and the second halves. Watch out for trends in deliveries, pricing, costs and forward sales and order backlog for reassurance or otherwise on all fronts. Analysts will also look for an update on Berkeley's build-to-rent platform and its cash return plans, both of which are key planks of the Berkeley 2035 strategy. The FTSE 100 members' latest goal is to return £640 million in cash to shareholders by September 2030 via dividends and share buybacks. That sum equates to just over a sixth of the current stock market capitalisation. Thank you for watching. Hope that you and your families are all keeping well, and I look forward to seeing you again next time.